What in the world is a hybrid pension?
And is it a scam?
Well, if you're watching this video, you might have never heard of these two words, hybrid pension.
So in today's video, we're going to discuss what is a hybrid pension and 5 ways on how to avoid being scammed.
Also pay attention to the end of this video where we'll discuss if hybrid pensions are really such a great investment, then why have most never heard of this concept?
Now, before we discuss how hybrid pensions might be a scam, we need to first understand the concept of a hybrid pension.
A hybrid pension is where you get lifetime income like a teacher, government worker, but you still have complete control over your assets. Let's illustrate it with Anne's purse here and this piece of paper, this packet. Now, my paper represents a traditional pension, income for life, which is always through an insurance company. Even your Social Security is through an insurance company called FICA, Federal Insurance Contribution Act.
Now, what makes it a hybrid is you have control over your cash, 401k, or IRA. However, you have the pension as an add-on called a rider. What this means to you is this. If you change your mind, you can cash out. If you passed away prematurely and while you're taking income, your asset will still grow.
That's right. Now, what if you are taking out more income? You don't have to take out that much. But what if you're taking out more?
Ones. Why are they all ones?
I don't know.
Where's my hundreds?
But if you're taking out more income than you've actually put in and the interest cannot keep up with all of your withdrawals, or you're living longer than you expected, then you will still have the income for the rest of your life.
Yes, all guaranteed in writing.
That's right. Not from us, though.
Of course not. No, it's from the insurance company.
Why were the hybrid pensions created in the first place? Well, let's break this hybrid down into 2 parts. The first part is a pension. Now, if I were to ask you, do you wish you had a pension like a teacher, union, or government worker? What would you say?
Yes, of course.
Why? Think about it. You'll never worry about outliving your money. And your money is never dependent on the stock market's performance. You'll have income that is guaranteed for the rest of your life. Guaranteed income that is recession-proof. Guaranteed income that you or your spouse will never outlive.
Yes, that's right, Kai. And many of our clients that have a pension are receiving 90 to 100% of their salary for life. Now, Kai just discussed the benefits of traditional pension. I'm going to discuss the benefits of the other side, an asset. Imagine this purse of mine as a 401k, IRA, or savings account. Now, true, with a traditional pension, we do have all of those guarantees and our income is guaranteed for life, as Kai just mentioned. A traditional pension, though, has no asset. Therefore, we cannot grow our money and we have no control over our money. We also have to hope for the solvency of the pension company, hoping it never goes bankrupt.
Those are called immediate annuities, which we would never buy.
Definitely not. A 401k, IRA, or savings account is not controlled by some pension or insurance company. We can cash out all our money or pass it down as a legacy at any time. By investing our money, we hope to have income that we never outlive.
So for years, you have only one choice. You either work for a company that gives you a pension or gives you a 401k plan. And did you notice Anne's last few words? With an asset, you hope you have income that you never outlive, but it's not guaranteed. Think about why so many people have to work until their late 60s or even their 70s.
You might think it's the cost of living, right?
Friends, it is not the cost of living. That is not the reason why people have to keep working. It's due to the lack of a pension, guaranteed income in retirement. What proof do we have? Well, think of all your friends or family that have a pension today. Think of your post office workers, your police officers, your firefighters, your union workers. How many of them have to work past 65? Do not most of them retire around 55 to 65 years old, even with today's cost of living?
To your point, Kai, before 401ks were introduced in the 80s, many companies offered a pension and health care for life. Employees would commit to their job just to receive their guaranteed salary and health care in their retirement, which allowed many to retire early.
Yeah, but unfortunately, that's not the case today. Only about 10% of jobs or less have a pension today, and even less have health care for life.
That's why in the 90s, the hybrid pension started to evolve, giving retirees the control over their assets, yet have the peace of mind of having income that is guaranteed in writing for life. Now, you might be wondering if this has been around for so many years, then why don't people know about it? Well, we'll discuss that in a bit.
So where might a hybrid pension be a scam? Well, to be clear, the concept in itself is not a scam, but the way it's presented or marketed can make you feel as if you've been scammed. Let's discuss 5 ways.
Number one reason you might feel like a hybrid pensions are a scam is from those marketing against these type of programs. Who's mainly behind all the marketing? Wall Street. There are so many articles that discuss guaranteed lifetime income, but they paint them in one way. Don't buy an annuity. You'll lock up your money for life and have no control.
So if you feel as if you've been scammed, it's because you read or were told it's a scam and didn't know the terminologies, like understanding a new language. 你好吗? So let's learn the language. The first words to learn are immediate annuity or annuitization. If you annuitize your money, you have locked up your money in exchange for lifetime income, but you can never change your mind.
So to be clear, a hybrid pension is not this type of annuity where you lock up your money for life in order to get lifetime income. The funny thing is, most people do not realize a traditional pension, like a teacher or government worker, as shown on these websites, is a traditional annuity, also called immediate annuities.
It's the same thing. It's interesting how Wall Street tells people not to buy annuities and how they make people think annuities are bad, but would never say pensions are bad.
Yeah, they're just contradicting themselves.
Yeah, many of you know that we do not recommend those type of annuities as we discussed earlier, the immediate annuities. And at the very least, we're very specific why we don't like those immediate annuities and tell you what type of annuity it is. And yes, you do get income for life, like we just discussed earlier, but you lock up your money, you have no cash value. Why would we do that when we have the option as a hybrid to cash out? We would personally rather have a hybrid that we have control over the asset while guaranteeing income at the same time, again, as a hybrid.
These immediate annuities are not hybrids, obviously. So why the confusion? Because the financial advisors and investment firms behind these articles tell you to stay away from these guaranteed income annuities because you have no control. However, if you look closely, they don't mention which of the 5 type of annuities they are referring to. They don't even mention the words immediate annuities or annuitizing your money.
And you don't even know what that means. So how are consumers like you able to be educated if you're not clear which annuity they're referring to?
This now brings us to scam number 2. Some feel cheated after buying a hybrid pension and later finds out that their fees are around 3% to 4% per year.
Ouch.
Again, there are 5 types of annuities, and the only annuities that can have that high of fees are variable annuities.
Why are we mentioning variable annuities? Because there are only 2 types of hybrid pensions. One is a variable annuity. Now, what is a variable annuity? Simply put, your cash value is typically invested in the market. So you either make money or lose money, hence the word
Variable.
Yes. Therefore, financial institutions, broker-dealers, and financial advisors can charge many hidden fees listed here on the screen. And all these fees can easily add up to 3 to 4% per year.
So imagine you bought variable annuity with a lifetime income rider, making this a hybrid pension. Your income is guaranteed for life, but you feel cheated because it was marketed as guaranteed and it was not clear that your cash value is subject to market risks. You also feel scammed when you find out that you're paying 3 to 4% in fees. So to be clear, we are not fans of the variable annuity as a hybrid pension.
Remember, before we started our business about 18 years ago, her mother, your mom, bought 2 of those variable annuities.
Yes, she paid so much in fees that she could have bought a nice Mercedes
For you or for
for all of us.
friends? To give you a perspective, if you had $500,000 and you were paying 3% in fees, that's around $15,000 per year. Imagine you paid that for 10 years. That's $150,000 in fees. This is the main reason we typically do not recommend a variable annuity as a hybrid pension. So if you or someone you know were a victim of these type of annuities and the lack of clarity regarding these high fees and potential loss of principal, share your experience in the comments below for everybody else.
The goal of this video is to protect you and your loved ones from being scammed. So feel free to contact us by email or call us. We don't work for any broker-dealer and are completely independent. We do not pretend to be financial advisors. We don't sell stocks or any variable products. Our focus is strictly on guaranteed income and healthcare planning, and we have a combination of over 50 plans and can assist in all 50 states. So we hope to hear from you soon. Okay, so scam number 3. You bought a fixed indexed annuity as a hybrid pension. How might you be scammed with a fixed indexed annuity? Well, first, let's talk about the good point of this type of annuity.
And these are the only hybrid pensions where your principal has no risk.
But imagine this happened to you. You bought a fixed indexed annuity. You were promised to receive the gains of the market's performance with no losses. Wonderful, right?
Yeah.
But later you found out your earnings only averaged 2 to 4% per year for the entire contract. Why? Because no one bothered to tell you your cap rate is only 2% to 4% per year.
Yeah. That reminds me of the new slang that the kids always say, that's cap. Now, for those of you who don't know what the new slang means, it means it's a lie.
In a way, it is a lie when you were not told about the cap. Well, what is a cap rate? A cap rate is the maximum interest you will earn from the insurance company.
That's right. Now imagine the index performs well, let's say 10%. Naturally, you're getting all excited, you're going to earn 10% from the insurance company, but then you're getting only 2 to 4%. And you're like, what the? How did I only earn 2 to 4%? And the market did 10.
Yeah. And it did 10. Yes, how would you feel if this happened to you?
That's cap. My kids are going to cringe when they see this part.
They will. Yes, that's why it's on our scam list. Most consumers were never told about this cap rate, or the advisor never made it clear.
To make matters worse, you later were told after you brought it to their attention, well, it's plainly stated in the contract. You know what I would say to them? What the? How am I, as a customer, supposed to understand all the terminologies? Did I go to school to learn this? No. I mean, the advisor is the one that's supposed to be transparent and take the time to teach me. If I'm supposed to read and understand everything I'm reading, then I don't need the advisor. Sorry, that's a big pet peeve of mine.
Yeah. Well, we've come across too many customers that fell victim to this. If what we just discussed has happened to you or someone you know, please share your experience in the comments below. This now brings us to scam number 4, low participation rates.
What is a participation rate? This is another limitation the insurance company can use to limit your earnings. The participation rate is a percentage of the market gains you get to participate. Let's say, for example, the insurance company says you have no cap, but then they give you only 50% participation of the market's performance. So, for example, the market went up 10% per year and you only get 50% participation, then that means 50% times 10% is
Only 5%. So again, if this happened to you and this was not made clear to you, wouldn't you feel scammed?
I would.
Now, there are a few insurance companies with no cap and high participation rates. And here at KCIIS, our goal is to find you companies with no cap and high participation rates. And we have no quota to hit with any particular company since we're completely independent. So feel free to call or email us here below.
Of course, there are other things to look out for as well. But like the engine and transmission of a car, the cap and participation rate are the 2 key factors to consider. Look out for our other videos where we go into further detail regarding these fixed index annuities. This now brings us to our final scam, scam number 5. Don't be fooled by the guarantees.
Another way you might feel scammed is because the insurance agent or financial advisor sold you on what's called guaranteed roll-up rates.
And no, we're not referring to the fruit roll-ups we all ate as a child. I don't even know why people like those. It always stuck to my teeth.
Anyway, roll-up rates are when the insurance companies give you a guaranteed credit as a reward for delaying your lifetime income. Social Security does the same things. For every year you wait on your Social Security, they increase your income by 8% per year, right? So why do we say this is a scam?
Well, here's why. They make these guaranteed interest rates sound like you're getting interest into your cash value. However, these guaranteed roll-up rates are not interest earnings into your cash value, rather into the other side of the hybrid, your lifetime income rider value.
Remember, this is called a hybrid pension for a reason. You have 2 parts to this hybrid.
Right, so let's draw this out. You might want to grab a piece of paper and follow along. Draw a line down the middle of the page.
And on the left side, write down a cash value of $500,000. The cash value is a value where you can change your mind, cash out, or pass it on as a legacy. Your cash value will never lose its principal from market risks and receive the potential gains by tracking the performance of the market. Click on the description below or call us to learn more about how your money grows and is protected.
On the right side, write down the pension or guaranteed lifetime income rider, also called living benefit. Now, under this right side, write down two keywords: formula value. Under formula value, write down this example, $500,000. Now, this is where the confusion begins, so pay close attention.
The $500,000 is taken from the initial deposit you gave the insurance company. Many think this is also a cash value. However, we cannot emphasize enough that this lifetime income rider side is a formula value only. Think of your Social Security or traditional pension through work. Your earnings or salary is calculated as a formula, isn't it?
That's right. Well, the guaranteed lifetime income rider works the same way. The insurance company will take your deposit and then give you a formula to calculate your lifetime income benefit. Get it?
So, what's the issue then? It's this guaranteed roll up rate credit.
I call this the guaranteed roll-up headache. Let's use 8% as an example. Now, as a reminder, you will not be getting this 8% per year where? Into your cash value. Remember, this is used as a formula only to calculate your guaranteed lifetime income rider. This in itself is not a scam. Again, Social Security is something similar.
And the 8% increases that Social Security gives you is not an interest deposit into your bank account. They simply use this as a formula to increase your income per month.
Yes, that's right.
Well, how does this simple roll up rate end up on our scam list and give us a headache?
Well, let's go back to that $500,000 example. Now, besides the roll-up, many insurance companies also give you a bonus. So here's an example. If an insurance company gives you a bonus of, say, 20% and then 8% per year, if you look here, your formula will double in 7 years, or your $500,000 formula will turn into over $1 million. Now, let's multiply that $1 million with a lifetime payout of 5% per year as an example. How much would your income be?
$50,000 per year for life. Well, what if they didn't use this confusing roll up rate and just said they will give you 10% of your original deposit?
So you're saying if the $500,000, or excuse me, on this side, if the $500,000 formula stayed the same, no roll up, but they gave you 10% of your original deposit, well, that would be the same. 10% times 500,000 is $50,000, the same as the first example.
Right. So why do they have this roll up rate?
One word, marketing. Think about it. What sounds better? A formula that does not grow or one that grows and doubles in 7 years? Do you see how the one with a guaranteed roll-up rate is easier for someone to use as a sales pitch?
Yeah, it's easier to use as a sales pitch, and it's also easier to confuse a customer.
Now, I've explained this to even our engineers, those who are really good at math, and they all say that this is very confusing. But this reminds me of actually someone I played tennis with. This was back in 2010, and he told me that he bought a hybrid pension. He was told that his money would double in 10 years. Now, this was in 2010, and I said to him, well, wait a minute. We're just climbing out of a recession, and you're telling me that an insurance company is going to double your money in 10 years. I said, that sounds too good to be true. So I said, why don't you come over to my office and let me review it? So I reviewed his policy, and I had to show him that his asset was not going to double, that it was his pension value that was going to double. Now, when I told him this, you can see steam coming out of his ears. To make matters worse, the person that sold it to him was a friend from church. So that's how important it is to know the differences between these two values.
And so here at KCIIS, not only do we want to be transparent, but we would rather give you clarity and lessen any confusion. So if there is a roll-up rate, we will make it clear that this is used as a formula only for your pension side and not your cash value side.
However, we will do the math for you and just tell you the final payout. That's all we care about. As if you had no roll-up. We would rather discuss the original deposit of, say, $500,000 times 10% without confusing you with all of this roll-up rate. Our goal is to give you the simple math and find you the carriers that can pay you around 7, 8, 9, 10, 11, 12, 13, 14, yes, even 15% per year of your original deposit as a minimum as income for life guaranteed.
That's right, 7% to 15% per year in writing for life.
Period. Simple.
Oh, and the companies that we will find for you either have 0% or no more than around 1% in fees.
Not 3 to 4% like those variable annuity hybrid pensions.
So if there are good hybrid pensions out there, especially the ones with very little to no fees, then why don't most financial advisors and broker-dealers mention these?
Two main reasons. Number one, they can never charge all of those yearly management fees and other hidden fees we discussed earlier, since there's nothing to manage.
Right. And number two, financial advisors have to work with a broker-dealer in order to sell stocks, bonds, and mutual funds. While immediate annuities, and fixed index annuities typically do not count towards those quarterly and yearly quotas called assets under management. Well, why? Because with a fixed product, there's nothing to manage. No advisor can charge you management fees or anything fixed like a checking or savings account, a CD, traditional pension, or your Social Security.
Correct. Here at KCIIS, we can never charge you a management fee either. As a matter of fact, no financial institution or advisor can charge management fees on any of these following guaranteed income solutions: your Social Security, your pension through work, and this fixed hybrid pension.
Right. Only these three options have the words income for life, guaranteed in writing. As a matter of fact, no institution, such as a bank, real estate brokerage, or Wall Street, can promise income for life. Only an insurance company can. And as you've seen from our other videos, even your Social Security has to be funded by an insurance division called FICA taxes, or the Federal Insurance Contribution Act.
Correct. Only an insurance company can put in writing guaranteed income for life as a hybrid. And as a hybrid, there are only two types. One, the variable annuities, which we recommended to stay away from due to the high fees, and a fixed index annuity.
Now, don't get us wrong. We do believe in growing your money in different buckets like stocks and real estate. We just feel it's wrong for our financial industry to educate so much on stocks, bonds, options.
And even Bitcoin.
Right, even Bitcoin. But hardly anything on hybrid pensions.
Right. We challenge you to Google it. The only thing you're going to find are employer hybrid pensions. Those are not really hybrid pensions. Those plans simply give people a choice to take their pension or cash out, not both at the same time that we're talking about.
As a matter of fact, most of our clients that meet us for Medicare said that their first time hearing about these hybrids is through our office.
Right. Yes, friends, retiring with no lifetime health care through your employer is already stressful enough. The last thing we need to worry about is outliving our money, which is the number one reason why people cannot retire early.
Yes, having an amazing, guaranteed, high payout income for life is the key to retiring happy and retiring early. But just be careful.
Yes, don't be capped or scammed.
We know we cannot expect you to grasp everything we discussed in one video, so that's why we created this playlist here.
In this playlist, for this one here, we'll also compare investment strategies to hybrid pensions. Which is better? And do you even need a hybrid pension?
When you retire, we hope you can say goodbye, tension,
And hello, hybrid pension.